Hello everyone, welcome back to Market Dialogue. This video is a part of educational series where we decode the market price action from a smart trader's perspective. Let's begin. Last month, I had posted two educational videos on Nikola Tesla's quote. If you have not watched them yet, please check the links in the description below. I strongly recommend every viewer to understand the first two videos before watching this one. As mentioned in the earlier videos, this community deals with only the price action in confluence with time and money. Only then we presume profitable trading is a possibility. It is always important to check the energy, that is money, frequency, that is a time factor, and vibration, that is the price action itself. In any plain chart, as you see, we are immensely lucky to have the access for all the price action charts in the entire trading world. This is a priceless gift. Once a candlestick is printed on a chart, it can't be undone. With this one priceless data, it is the idea of the market dialogue community to crack the money factor and the time factor in charts. That is when we can crack the secret of trading as per Nikola Tesla. There is no doubt all the three are mutually connected because the price action you see on charts has time on x-axis and price on y-axis. When price moves at a particular frequency, it creates liquidity, and those transactions are indeed an energy component. Hence, there shall not be any further doubt about one factor has the authority to impact the other two. Our main motto is to find how money transactions and time factor shall be the base to foresee price action. Coming back to Nikola Tesla's quote, if you have to find the secrets of the universe, think in terms of energy, frequency, and vibration. It is no joke. Take a moment to pause this video and check if this concept could be applied on your primary job or any invention around you. To see success in any field, one has to take care of these three factors, which in turn decide the outcome. If you still have queries on this concept and application to any field, feel free to ask me in the comments and I can make you believe it works pretty well with trading too. Now let us learn how to apply the same logic on a real chart. I would be extremely happy to look into the charts of your interests. If you feel this video makes sense after watching, comment on this video. To make this video, I will be choosing price action charts alone to showcase the real application of the concept. Watch my previous educational videos to know who are buyers and sellers in calls and puts. The entire concept can be understood in 4 simple steps, and this is for the benefit of market dialogue community. First step, trap move. It is abbreviated as TM. Second step, trap move stop loss hit, abbreviated as TMSL. Third step, liquidity grab. It is abbreviated as LG. Fourth step will be the breakout. It is abbreviated as BO. Let's dig deep into each step. First, trap move. It is one particular price action where the price makes a new high or a new low, be it breakup or breakdown from a consolidation zone, or be it price making all-time highs or all-time lows after a considerable amount of time. It can be called as the trap move. The reason why the community look up such a type of price action as trap move is because that is the exact move where most of the retail traders enter the market. They do aggressive call buying when the price breakout on the uptrend after a consolidation or on new highs, and they also do aggressive put buying in case of a downtrend after a consolidation and new lows, right? FOMO, that is fear of missing out, will be the psychology of the retailers who fall into this sort of trap. Hence, it is important to understand every price action of such type is a trap move. And eventually, smart money does not allow these retail entries to reach their targets, like we had already discussed in the earlier educational videos. This trap move ends when there is no call buying or put buying pressure from retailers. If it has enough buying interests or enough selling interests from retailers, why the smart money wouldn't trap them all, correct? The second step will be trap move stop loss hit, abbreviated as TMSL. It is understood that with this price action, after the buying pressure or selling pressure has ended, the price starts retracing back. How that happens is not important, but the majority of retail traders exit with a loss when price retraces back somewhere ranging between 35 to 75%. The range mentioned is not important, but it is important to check the psychology of retailer who is seeing a reversal. Do they accept heavy losses? No, right? He or she will definitely exit when price is retracing at some point of time. Only when most of the retailers who entered in the trap move got exited, that's where this trap move stop loss hit will end. Just a quick note, let's assume if it is not a trap move but a directional move. In either of the cases, the price has to retrace and hit the stop loss of majority of retailers. Why? Because the smart money does not allow majority of retailers to have profits, and that's our biggest assumption we had discussed. If I had watched the earlier videos, you would know that by now. Moving further, the third step will be the liquidity grab, abbreviated as LG. This is an important step that decides the fate of our future trades, without which the trade opportunity ceases to exist. After the recent trap move stop loss hit, it is important to look into the retraced price move that took place in the opposite direction. Let's take uptrend as an example. During trap move, price breaches higher highs and consolidation zones with momentum. This is where most of the retail traders, that is the call buyers, enter with the fear of missing out of the opportunity to make profit. Once call buying pressure is reduced, trap move stop loss hit starts. During this phase, the new set of retail traders who see the retracement as an opportunity on the downward direction to make profits, they enter the market as put buyer. It is like two faces of the same coin. Let's take downtrend as an example similarly. During trap move, price breaches lower lows and consolidation zones with momentum, right? This is where most of the retail traders, that is the put buyers, enter with the fear of missing out of the opportunity to make profit. Once put buying pressure is reduced, trap move stop loss hit starts. During this phase, the new set of retail traders who see the retracement as an opportunity on the upward, the uptrend to make profit, enter the market as a call buyer. Hope there is no confusion here. So, what is liquidity grab? It is the price move that appears to grab the liquidity created by trap move stop loss hit. Once the liquidity created by TMSL is hit, that finishes the third step. Step 4, breakout. The final step shall be the breakout of price opposite to the first trap move. Every trader of the market dialog community has the authority to enter the trade with practical risk to reward ratios of 1 is to 1, which we shall discuss in next slides of this video. Earlier, when we had started to follow the 4-step market dialog trading strategy, it was the trap move we began with, and at the end, breakout happened in the opposite direction. Never forget this. Now it is my time to explain every possible scenario here. Let's start with uptrend trap move. TM appears as new highs. It means call buyers entered. Call buying pressure reduced after a while and TMSL move started. Put buying retailers entered in this move, leaving liquidity on the highs. Liquidity grab happens, followed by breakout, opposite to the first trap move. Now it is time to discuss the entry criteria of upward trap move in smaller time frame. Let's zoom in the area of breakout that has happened in this chart. If we bring it down to the smaller time frame, this is the chart every trader of the market dialog community has to follow. Higher time frame analysis and lower time frame confirmed entries are shown here. Every community member has to enter only after the same uptrend trap move shows up in smaller time frame also. Without this confirmation, it is not advisable to enter the trade. The same four steps show up in lower time frame too. It has to. Once it does, we will have two trade opportunities. One is higher time frame based 1 is to 1 risk reward entry and lower time frame based entry with a trailing stop loss. The benefit here is doubled as you can see. The first trade benefit of 1 is to 1 in higher time frame and second trade benefit having stop loss held at lower time frame stop loss and profit target held at higher time frame target. It is the time for you to assume the potential here. I'm not here to discuss on that part in this public platform. Let's discuss the downward trap move. Trap move appears as new lows, that means put buyers entered. Put buying pressure reduced after a while and TMSL move started. Call buying retailers entered in this move, leaving liquidity on the lows. Liquidity grab happens, followed by breakout opposite to the first trap move. Now it is time to discuss the entry criteria of downward trap move in smaller time frame. Let's zoom in to the area of breakout that has happened in this chart. If we bring it down to the smaller time frame, this is the chart every trader of the market dialog community has to follow. Higher time frame analysis and lower time frame confirmed entries as shown here. Every community member has to enter only after the same downtrend trap move shows up in the smaller time frame too. Without this confirmation, it is not advisable to enter the trade. The same four steps show up in lower time frame too. It has to. Once it does, we will have two trade opportunities. One is higher time frame based 1 is to 1 risk reward entry and lower time frame based entry with a trailing stop loss. The benefit here is doubled as you can see. The first trade benefit of 1 is to 1 in higher time frame and second trade benefit having stop loss held at lower time frame stop losses and profit target held at higher time frame target. In this chart, the second trade opportunity of a lower time frame stop loss and higher time frame profit target did not work initially. And yet, we are not on loss. We will be trailing the second trade. Trailing stop loss gets triggered only when there is an upward trap move in the lower time frame. So that is also a double benefit trade opportunity as shown in this slide area. It brings me immense pleasure to share with this perfect example that only after the lower time frame uptrend trap move double trades reach its targets, the price resumed its higher time frame downtrend trap move. It was again confirmed in lower time frame downtrend trap move. After all these risk to reward ratios you have seen in these slides, it is time for you to assume the potential here. I'm not here to discuss on that part in this public platform. I will always expect my community member to believe in this process and let the outcome take its own course of action. After this long discussion, now it is time for something even more exciting. Throughout all these possibilities, ever thought what if it is a directional move instead of a trap move? If you follow what I mean, then you're on the right track because there won't be a trap move at every situation, right? I can prove the upward directional move is also called as downward trap move, and downward directional move is also called as upward trap move. Now let's discuss those two scenarios. Uptrend directional move. The name uptrend directional move suggests that the initial step of the trap move appears in the direction of future price direction. As you can see in the chart, call buyers entered after a brief consolidation. Call buying pressure reduced after a while and TMSL move started. Put buying retailers entered in this move, leaving liquidity on the highs. Third step, that is liquidity grab, happens, but it is not followed by a breakout opposite to the first trap move. Instead, after the liquidity grab, it shows a minor pullback and the breakout happens in the direction of the first trap move, but not opposite to the first trap move. Hope it is clear. Now it is not like we are not following the four steps in the market dialogue trading concepts. We are still following the same. Ask me how. From the same chart, if you keenly notice, it is not uptrend trap move, actually the first move, but it is the TMSL, the actual first move as trap move. And from there on, upward directional move turns into downward trap move, and the rest of the steps are followed until the breakout opposite to the downward trap move. Coming to downward directional move, the name downward directional move suggests that the initial step of the trap move appears in the direction of future price direction. As you can see in the chart, put buyers entered after a brief consolidation. Put buying pressure reduced after a while and TMSL move started. Call buying retailers entered in this move, leaving liquidity on the lows. Third step liquidity grab happens, but it is not followed by breakout opposite to the first trap move. Instead, after the liquidity grab, it shows a minor pullback and the breakout happens in the direction of the first trap move, but not opposite to the first trap move. Hope it is clear. Now, it is not like we are not following the first four steps in market dialogue trading concepts. We are still following the same. Ask me how. From the same chart, if you keenly notice, it is not downward trap move, actually the first move, but it is the TMSL, the actual first move as trap move. And from there on, downward directional move turns into uptrend trap move, and the rest of the steps followed by breakout opposite to the uptrend trap move. I'm pretty sure most of the viewers are indeed confused about the new terminologies used in market dialogue community. I suggest all viewers to watch the confused sections of the video at lower playback speeds if necessary. With this, as a founder of the community, I once again confirm that to trade any price action charts, we will not need indicators, no imbalances needed, no volumes, no MACD, no moving averages, etc. etc. It is pure retail psychology we are supposed to analyze, and our success lies in taking action against the retail psychology with the help of energy and frequency of charts. This video is not complete with all the steps explained because we have covered only the vibration of charts, that is price action, but analysis and discussion of energy, the money factor, and the frequency, the time factor, in the similar way as the price action of charts is not entertained. Because it is the combined decision of the founders of the community for the community's betterment and endurance, we have decided to preserve the blueprint which helped to foresee the market price direction. And yet, the subscribers of the community's YouTube channel shall have the privilege to discuss any chart of their choice, either by commenting on the video or by inquiring about the chart in Telegram group Market Dialogue. Let's start with what is covered here. Market price action. It is fully covered. On this channel, price is the priority. You'll get free access to price action concepts for every year with no membership required. If you comment with the chart or post it in our Telegram group, I'll provide free analysis and clear explanations based purely on price behavioral structure, support and resistances, and market psychology. No guessing, no shortcuts, just by how price actually move. Now let's be very transparent. Market time factor is not covered here in this video. Understanding how time impacts the final outcome of a move and when it is likely to play out is something reserved for community members only. Yes, you must still receive a free chart analysis with respect to time, but only without detailed explanation of the time element behind it. That is, there will be no explanation shared for analyzing time with respect to energy and vibration, but the final verdict will be shared for free on request. This keeps the learning structured and fair for those deeply committed to market dialogue. That is the idea. Similarly, market money factor is also not covered publicly in this video. Position sizing, capital deployment, and how money truly influences the final result of a trade, these insights are shared only within the community. Publicly, you may get final outcome of analysis, but without the detailed explanation of the money factor behind the trade, it is not revealed. That is, there will be no explanation shared for analyzing the energy with respect to time and vibration, but the final verdict will be shared for free on request. This channel is built on one principle: transparency. Stick to this channel to get updates on monthly trade challenges and performances. Price action is free, knowledge is shared honestly, and deeper insights are reserved for those who chose to grow together as a community. If this approach resonates with you, subscribe, drop your chart in the comments, and start learning how price action really work. We shall grow together for free. All right, let's wrap this up. Remember, your trades are your responsibility. I'm saying it again. I did it in the previous video and I'm saying it again and again. It is all your responsibility, not mine, not anyone else's. Learn to read the market, don't just react to it. Take time to review what we covered today. Once again, go back through your own charts and look for these price action combined patterns. Mark the analysis. Watch what happens next. I'll see you in the comment sections. Share your thoughts, your questions, your own observations, and I'll see you in next week's session where we'll dive deep into specific setups we have discussed now and even more for the upcoming week. Until then, decode the market, trade with clarity, and remember, it's market dialogue, not market noise. Thank you for watching.